So this week we're studying, last week we studied capital budgeting decision criteria, and we came to understand the theory of how one tries to go about making capital budgeting decisions. But one of the things that we didn't do in that chapter is we did not take account of what should be obvious to one and all. That is that we don't really know the cash flows that lie in the future, do we? So what we want to do in this chapter is figure out how do we factor in what we know to be true, that the future is uncertain, when we're going about the business of capital budgeting. Now, we're going to learn some methodologies and some theoretical concepts, and they will be helpful, but they won't get us out of the woods in the end. And the reason they won't get us out of the woods in the end is because we can't tell the future in the end. We do not know what the future will be. In fact, I've told students for years, if you know the future of practically anything, and you actually know it, I know a way that we can make money from it. And a lot of money, even if the only way we could do that is to go to Vegas and bet on it. You can bet on practically anything in Las Vegas. All right, well, here are some questions that we should consider to get us going. How risky are stocks in general? Are they a little bit risky, or risky as all get out? Blindingly risky, or what? Would you ever buy one? And then that leads us to the next question, which is more akin to what we're interested in finance. How risky is the stock of my company? You know, if you are in the financial function of a company, a corporation generally, you know, there are all kinds of corporations. Mostly corporations is just a very common form of business. When we utter the word corporation, lots of people like my daughter think of the Fortune 500 and think that half of them are crooks and criminals. Yeah, well, maybe 2/3. But the truth of the matter is, corporate form of business is the most predominant form of business, whether the corporation is closely held or not. So usually we're talking about a corporation, but if there's stock of the corporation, then it's publicly traded. And we need to understand something about, well, is this stock risky? Is my company a risky company? And what's really going to be important about that is my cost of capital going to be higher because my company is risky? So what return will investors expect from my company before they would be willing to buy the stock in our company? You know, there must be a big difference between Kroger's and an oil exploration company in terms of how risky their stock is. Now, what might make you buy stock in Kroger? What might lead you to buy stock in a grocery store like Kroger? You might be interested in a stable, comfortable rate of return. Do you suppose that people that own Kroger stock are getting a rate of return? Well, they're surely getting something, or they'll sell the stock, for goodness sakes. If you're not getting anything, why would you hold that asset?
Probably not much more than the risk-free.
Probably not much more than the risk-free rate of return is a good answer. You know, the risk-free rate of return we take as a practical matter to be the 90-day T-bill rate. That's just what we use to measure it. But the idea of the risk-free rate of return is that there's no risk of default. And we understand the closest thing that comes to that is a 90-day T-bill rate. So if you were going to be induced to buy stock in a startup company that has just gone public with an initial public offering that makes some kind of medical device, what would induce you to do that? Well, you better believe that, at least, hadn't you? And you better believe before anybody would be interested in buying such a stock, or in a biogen company, you know, some kind of very small. You better believe that the rate of return is going to be rather high, or you wouldn't do it, would you? Why would you expose yourself to that kind of risk? So is the stock of our company overpriced, or is it undervalued? How would a company think? Would a company be interested in thinking about that? A corporation? Well, sure. Because one of the reasons that they'd be interested in that is if they think that their stock is overpriced, has greater value than, has a higher price than its true intrinsic value, they'd be interested in issuing some stock to gain some more access to more money, more capital to work with, because they'd realize that we'll be getting more than getting more money than it's worth. That's always a good thing, right? What if they think their stock is undervalued? They might be interested in buying some of it back. Why? Because it will increase the shareholders' wealth to do so. Because ultimately the notion would be that finally the market will price our stock correctly and our shareholders will make money from that. Okay, so these are just some very practical questions I wanted to raise. Anyway, we want to learn to measure and interpret market risk. What does that mean? We want to come to an understanding of the term beta. Very useful and easy concept to understand really once you get inside it. We want to be able to estimate the expected rate of return that investors, quote, require for a particular security. Now, this language is a little clumsy, and I like to point it out to you that it is, and try to get you to a deeper and more solid understanding of what this means. In what sense does an investor require a rate of return? And in what sense do investors, plural, require a particular rate of return or require a return? Or in what sense do investors, plural, expect a particular rate of return? What do those words mean?
It means that
they even reminds us correctly of the opportunity cost notion that if a person is going to put money into this particular project or this particular stock or buy this particular financial security, they are mindful of the alternatives they are giving up. What is the rate of return that I expect to be foregoing to do this? And that's a very useful concept. You stop and think, well, at the very least, I could get the risk-free rate of return, couldn't I? I could buy 90-day T-bills, for goodness sakes. Or I could buy 3-year Treasury bonds, and those aren't very risky, are they? No, they're not very risky. In fact, there's no risk of default. There's only inflation risk then. It's not going, or there might be the risk that if I wanted to sell my bonds early, that I might suffer a capital loss if interest rates have gone up. You remember that kind of risk. So there is the opportunity cost notion. So we can have some expectation as a person. I do want to point out this. Investors in the plural don't have expectations. Do you share the mind of someone else? No, not a bit of it. The only mind you're aware of is your own. I mean, you take each other to have minds, but do you really know? No, you really cannot experience someone else's mind. So I really don't like the terminology that has grown up in the theory of finance, speaking of market expectations or investors' expectations, as if it were a real thing. It is not. An individual can have an expectation. An individual can have a requirement that they at least believe that this thing I'm getting ready to do has a higher rate of return than the alternative that I think I have. So I just want to point out to you, this is clumsy language, but it just is what we've been given to deal with in the theory of finance. But I don't want you to be duped into imagining that there is something like an expected rate of return. There really isn't. There's only the rate of return that comes about, and there's the rate of return that you hoped to get. And there's only you. You have to make your own decisions, don't you? And you make them alone. Now, we want to be able to calculate the risk-adjusted opportunity cost of capital for a capital project. Oh my goodness, what in the world does that mean? Well, we'll have to wait till we get there and read about it. Okay? Can't tell you everything right away. Well, here is then our overview and summary of this chapter. It will go by quickly. You will get only the slightest impression from these slides. You will have to read and read deeply, and if you don't get confused and have questions, that will tell me that you're not taking this seriously, because these are some difficult concepts that you'll find in here. The risk of a particular security, says on slide 11-4, depends on its contribution to total risk of a diversified portfolio. Now, everybody's aware of the barnyard nostrum, don't put all your eggs in one basket, right? And we all understand that that would be prudent, don't we? We all understand the meaning of that. That's the idea of diversification. Now, what does that have to do with what we're talking about? Well, it says here the risk of a particular security. Let's take a particular security like, say, a share of IBM stock. Well, now, how risky is buying a share of IBM stock? Well, the answer is it's going to depend on its risk in a totally diversified portfolio, as if you had added one share of stock to a diversified portfolio. And what this really means is that's all the market's going to compensate you for. Because you don't get compensated for taking risks you don't have to take. Someone doesn't have to take the risk. The market will not assign, through the interactions of buying and selling of individuals, a risk premium to it. Now, this is a very difficult concept. It's very confusing. Well, isn't it true that the more risk I take, the greater the rate of return I could expect? Yes, but the risk must be risk that has to be borne by someone, or the answer is no. Will you get a higher rate of return just because you're goofy enough to play craps in Las Vegas? Or will you get a higher rate of return just because you bet more at the roulette wheel? No, that's not risk that anybody has to take, is it? There is no risk premium available for taking those kinds of risks. On the other hand, there are certain kinds of risks that somebody must bear if we're going to have an economy, if we're going to have goods and services. Now you can expect to get remunerated for taking those kinds of risks. Now what does this mean then? It says, because unique risk, what we call unique risk, can be diversified away, and it can. Investors cannot expect to earn a risk premium for holding a particular security outside a diversified portfolio. So there is some riskiness of a particular security as part of a diversified portfolio. And you can expect to get compensated for that, but you can't expect reasonably to be compensated except by dumb luck for holding a particular security outside a diversified portfolio. And here's the difference. In a diversified portfolio, the unique things that could happen to a particular company don't have very much effect on the rate of return of the whole portfolio, do they? Because it's diversified. You don't have all your eggs in one basket. You have a bunch of different baskets, a bunch of different eggs. So if one basket falls to the ground and you break an egg, well, that doesn't hurt the other baskets. See? Not very much. Just a small, tiny little bit. Since you can hold your portfolio in a diversified fashion, you're only going to get compensated for the risk of doing that. And there's another reason that's more practical. Big financial institutions that have big money invested and are being managed by professional money managers, they are holding diversified portfolios. They're not holding individual assets. They're holding completely diversified portfolios, and they're paying prices for those securities that reflect just that risk. And so the prices of securities in the marketplace only reflect the risk in a diversified portfolio. Does that make sense to you? So if you go out and you buy one share of IBM stock, or 100 shares, or 1,000 shares, the point is you've just got that asset. You are exposed to all of the risk of IBM plus the risk of the marketplace in general, aren't you? The only risk that you must bear is the only risk that must be borne, I should put it that way, is market risk. No one needs to expose themselves to the unique risks of a particular company. So they won't get compensated for doing so. They'll just be taking more risk than needs to be taken with no expectation of a higher rate of return. Now that's a very difficult point to come by. But securities are priced in financial markets as if they are held in diversified portfolios, whether they are or not. So you can go out and buy 10 shares of IBM stock and not hold it in a diversified portfolio, but it's going to be priced as if you were holding it in a diversified portfolio. And so to the extent you're not holding it in a diversified portfolio, guess what? You paid too much for it. You won't be compensated for the amount of risk that you're really taking on. You see how you're paying too much for the stock if it's priced as if it were going to be just part of a diversified portfolio? Its price is so high that its rate of return is not low enough. It's lower than you expect it would be. All right, you'll have to think about that. I've said all I want to say about it. It took me years to come to understand that, so don't feel bad if it's not just warm and fuzzy with you right now. Well, the idea of diversification is easy to understand. The idea of why assets are priced as if they were always held in a diversified portfolio is a little harder to understand. But maybe you got it already. Good. The most important influence on fluctuations in price for any security, remember the big broad categories of securities we're talking about here are stocks and bonds, is fluctuation in the overall market. When the market goes up, practically every security goes up. When the market goes down, practically every security in the market goes down. Not always, not in lockstep, but it just is the case that we've done the research, we've seen it, that the greatest, most important, most significant influence on the price of any security is fluctuations in the overall market. And that's easy to convince yourself that that's true if you just watch stock prices for a while. You own some particular stocks and you watch those stock prices and when you see what the S&P 500 is doing, you'll notice that they move together. Well, beta, here it comes. Beta is a relative measure of how sensitive any particular security is to fluctuations in the whole market. By definition, the beta of the whole market is 1. Is unity, 1. So stocks with a beta greater than 1, what does that mean? It means that they're particularly sensitive to fluctuations in the market. And that shows up by the following phenomenon. If the market goes up 1% and a particular asset has a beta of 2, it's likely to go up, the price of that particular security is likely to go up 2%. Twice as much, in other words. See why it's relative? It's a fractional comparison. It's a percent comparison. If a stock has a beta less than 1 and the market goes up 1%, then the price of this particular stock is likely to go up by less than 1%. Okay? There are very, very few assets that have negative correlations. That is to say that when one goes up, the other goes down. Very few. There are some. Under some circumstances, gold has a negative correlation with other assets, but not under all circumstances. Well, but was it reliable? And the answer is no, it's not. If it were reliable, then we could all be rich, couldn't we? Yeah. But we're not all rich, and so it isn't reliable. And but it is the case that under some circumstances, gold may have a negative correlation with the market. But it's very rare to see two securities that have negative correlation. When one goes up, the other goes down. That's what I mean by negative correlation. Nearly all assets have a positive correlation. Beta has to do with how positively correlated is this asset with the market as a whole. And as it says here at the bottom of slide 11-4, the average beta across all stocks is 1. That means, in other words, that the beta of the market is 1. Okay? There's a lot more math to this that you could learn, but this is the basic idea. On slide 11-5, a risk premium, what is that? That's the extra return that an investor could require for taking risk beyond the risk-free rate of return. So if I buy 90-day T-bills, I get the risk-free rate of return. If I buy something other than 90-day T-bills, there's going to be some risk involved beyond holding the 90-day T-bill, isn't it? Why would I do that? Well, I must think that I could earn a risk premium from doing that. I wouldn't bother. Why would I expose myself to risk of loss unless I expected some gain from that, possibility of some gain? The market risk premium is the risk premium of the market portfolio. That leads us to the definition of the market portfolio. In pure concept, in pure theory, the market portfolio is all of the assets in the world. The whole world? Yeah, whole world. That's the idea of the market portfolio. That includes houses, valuable paintings, gold, stocks, bonds of all kinds, you name it. Whatever is taken to be an asset, the market portfolio is all of that. Well, there is no such thing, is there? There is no such thing as the market portfolio. On the other hand, we do have index. We do have stock indexes and asset indexes, and we take very large collections of assets to give us at least some notion of what the market rate of return is. And so it turns out that we could compare, if we took, let's say we took the S&P 500. There's a pretty broad portfolio, isn't it? That's the 500 largest companies, publicly traded companies in the United States. That's a pretty broad set of assets, isn't it? Stocks. And suppose we looked at the rate of return on the S&P 500 for last year, then we could compare that to the risk-free rate of return, the 90-day T-bill rate for last year, right? If we took the difference between them, what would you be willing to call the difference between them? I'd be willing to call it the market risk premium. Which would you expect to be higher, by the way? Well, you certainly would expect the rate of return on the S&P 500, the portfolio of that, to have a rate of return greater than the 90-day T-bill, for goodness sakes. And if your expectation were not correct for enough years, you'd quit buying stocks, wouldn't you? Well, sure. So that's the idea of the risk premium. From 1900, the year 1900, the year 2004, 1900 to 2004, the market risk premium averaged 7.6%. The risk premium. That means the additional amount beyond the 90-day T-bill rate. Averaged 7.6%. Okay? Nearly, I think 7.5%. The market risk premium has not been that high since then. From 2004 to 2005, forget about it. So we're in a little bit of an anomalous period, but 5 years isn't very long, is it? What does this point out to you? Well, the market risk premium isn't a constant. Some years, the market risk premium can be enormous. In some years, it can be negative.
That's in 1900.
No, that's 1900. That's a long period. That's 104 years. Right? So that's a long-term average. So over that long-term period, that's a pretty good risk premium, isn't it? In some periods, the 90-day T-bill rate was as high as 5-6%. It's not that now, is it? No. But in some periods of time in that 100-year span, 105-year span, whatever, the rate of return people were getting on average out of the market was as high as 12-13%. In any given year, what is the rate of return on holding the market portfolio, or a very broadly diversified portfolio like the S&P 500 or the Wilshire 6000? Over 6,000 different companies' stocks in the Wilshire 6000 index. And you can buy an exchange-traded fund that reflects the Wilshire 6000. So you can get that rate of return is the point. Okay, so in some years, the rate of return of holding the Wilshire 6000 is negative. You lose money if you held it and sold it for just 1 year. In other years, it might be as high as 40%. Yeah? So now we come to this idea, the capital asset pricing model, which is universally written as its acronym, the KAPM. What is it? It is a mathematical model that was developed a long time ago by a financial economist who won the Nobel Prize for it, by the way. His name is William Sharpe. Won the Nobel Prize in economics for developing this idea. Here it is in its simplest, most digestible form. And even saying, well, how tasty is that? Well, if you get warm and fuzzy with it, it looks like an old friend. Okay, it's really not complicated. First thing I want you to do is replace in your mind, instead of expected rate of return for the ICE asset, just put Y there. So this says Y equals something, and this is the rate of return on the 90-day T-bill, the risk-free rate. I don't know why we use F, we just did. I guess free, whatever. This is beta. And then this is another variable. Let that be x. What is y equals a plus b times x? It's the equation of a straight line, for goodness sakes. Well, if you've had any analytical geometry at all, then you should be really warm and fuzzy with the equation of a straight line. And if you aren't, why then I can't help you very much. At this point, you'll need to take some more math. The mathematics of straight line is so fundamentally basic, and not to say simple, but basic. After a while, it does seem rather simple too, doesn't it? Why? Well, it is. There is no rocket science. There are only rockets. Once you understand what's going on, nothing's hard. So don't let the notation bamboozle you here. First of all, I've already told you that there is no such thing as the expected rate of return, haven't I? That is a theoretical notion. There is no market expected rate because there's no market to do the expecting. So this is a theoretical construct, and I want you to understand it as such. It's a useful one, but don't get too all bound up in it, you know? It's just a model. No. It's there to help you a little bit. All models are only useful in so much as they help us think about the relationships among some variables. What is a theory? A theory is an abstract statement about the relationship between two or more variables. What is a model? A model is a statement of a theory. This happens to be a mathematical statement. Okay? Some people look at this and they say, well, this is so easy, I'm not intimidated at all. Other people look at this and say, run in terror, and their eyes roll back because it looks like math, right? So y equals a plus b times x. Now, what is this saying? The risk-free rate of return is a constant. We take that in this equation as a constant. It's given, in other words. It's not a variable. And what do we use to measure it? How do we measure that in the real world? The 90-day T-bill rate. The United States 90-day Treasury rate. We don't worry about why it is what it is just is, and we take it for given when we think about the capital asset pricing model. So what does it say now? Well, I've got some asset that I'm going to call the ith asset. Maybe it's a share of IBM stock. Maybe it's a bond, whatever it is. It's some asset. Now, what could I expect? Maybe you should look at it this way. What should I expect its rate of return to be? As a person, since only persons can do expectations, you might put it that way. Even though we recognize that to be a normative question in the realm of philosophy, maybe that'll help you understand. What should I expect out of this asset? Well, the answer, according to Bill Sharp, was take the risk-free rate of return, whatever it is, and then to that add the beta of that asset, whatever the beta for that asset is, and multiply that times the rate of return on the market portfolio minus the risk-free rate of return. We recognize now this X over here to be the market risk premium. If in fact the market risk premium has averaged 7.6% over the last 100 or so years, and I thought that the future was going to be like the past, then I might plug in 7.6 here. And then if I knew the beta for this asset, whatever it is, then I have a way, according to Bill Sharp's theory, for coming to expect a particular rate of return for that asset. That's all this says. So in words, the KAPM says that the risk premium for any security is proportional to its beta and the market risk premium. Well, that at least gives us a way to think about things if it turns out that the capital asset pricing model is a useful description of reality. And you will read in your textbook some words about how useful it has turned out to be or not. Is it reality? No. The capital asset pricing, it's a model, for goodness sakes. Is any mathematical model reality? So, is E equals MC squared reality? No. It's a mathematical model of reality. Is it right? Oh, now we're getting into very deep questions of epistemology, of what is true and how do we know it's true. We probably don't want to dwell there too long, interesting as it might be. Now, E equals mc squared is not reality. It's a mathematical equation that has done a decent job of describing reality so far. Same thing with Bill Sharp's equation here. It is not reality. It is a decent description of reality. So, how do you use this? Let's plug some numbers in here for a minute. Suppose I told you I have an asset in mind here. It's a bond. It's a bond of the XYZ Corporation. And I know it's beta. Never mind how I know it's beta. I just know it's beta. And its beta is 1.5. Now immediately, if you have understood what the beta means, that means that it is going to be the case that when the whole market goes up, the price of this asset tends to go up even more. So for every 1% increase in the market's rate of return, the rate of return on this bond tends to go up 1.5 times, 1.5%. That's the meaning of the beta. Don't ask me how I got the beta. I'll tell you that later. Just suppose that I know the beta. Okay, so I know the beta. And then suppose that I know an average of the market risk premium over the last several years. Then what this capital asset pricing model simply says is take 1.5, multiply it times the market risk premium that you have in mind, and if we took this long range average, we'd say 7.6, multiply them together, add to that the 90-day T-bill rate, that's what you can expect to be the rate of return out of this stupid bond. Will that be what happens? Almost certainly not. Why? Here's why. It's a model, and here's the other reason why. Here's the way a trained statistician thinks about this. Have you ever seen anything that looked like this before? And here we have ROR, rate of return, for the ith asset, and right there is the expected rate of return for the ith asset. And what is this? That's a distribution. This is the language of uncertainty. Probability theory is the language of uncertainty. We do not know what the rate of return will turn out to be on this bond, do we? But what can we expect? I would encourage you to think of it in terms of the statistical expectation. When you look at the word expect in the context of financial theory or investment theory, I would encourage you to be thinking of the statistical meaning, the mean of a distribution of possible outcomes. So what Bill Sharp, and this is exactly what William Sharp did, he developed a mathematical model that said the mean of the distribution of the possible rates of return for the ith asset can be calculated just this way. Take the asset's beta if you can get that from somewhere. Never mind where yet. Multiply that times the market risk premium. Add to that the risk-free rate of return, and you will have what? The mean of the distribution of the possible rates of return on the ith asset. That's what you'll have. Well, guess what? William Sharp was a pretty smart guy. He still is, near as I can tell. And the rest of the financial economics community thought that that was so brilliant that he was awarded the Nobel Prize years later. Now, here is on slide 11-6 a picture of what we just looked at in terms of a mathematical equation. And it has a name associated with it. It's called the security market line, the SML. It is a representation graphically. What is the SML? A graphical representation of the capital asset pricing model, that's all. On the vertical axis, we have a scale on which we want to measure rate of return, and in particular, we're thinking of measuring the expected rate of return, but we're just measuring rate of return in general. It's just percentage rate of return. Of course, you see down here at the vertical intercept, which is the vertical intercept of the capital asset pricing model, that is the risk-free rate of return. So evidently, the 90-day T-bill rate in this diagram is 4%. Okay? And then we see the straight line that has been plotted. And we see here we're measuring on the horizontal axis beta. And so we know 2 points of the line. That gives us the whole line, doesn't it? We know that a beta of 1 matches up with what? What does it match up with? And on this straight line, what should we be able to read over here on, we do read 13, but what is that 13%? What is that 13%? It is the rate of return on the market portfolio. Now we can only know the rate of return on the market portfolio ex post, right? We can't know it in advance, but we can look into any historical period and calculate what it was. Can we not? And so the way to think about this is to do just that. Look into the past, and we can say, well, if we look into the past over the past 10 years and just calculate what the rate of return was on a broad, diversified portfolio like the Wilshire 6000, well, maybe it turned out to be 13%. That was the average rate of return over that period of time. You realize, of course, that each period you choose would actually have a different rate of return, but if you average them together, you get some average. And then we look over the 90-day T-bill rate for that same period, and we find that it was an average of 4%. So now we know that the 4% matches up with a beta of 0. Why is the beta 0? The beta on the risk-free asset is 0. It has no correlation to the market. It's the risk-free rate. It's guaranteed, in other words. There's no risk. So the beta of the risk-free asset, which we use the 90-day T-bill to measure in the real world, is 0. The beta of the market portfolio is 1. The rate of return on the market portfolio, ex post, we found to be 13. The difference between them is called the risk premium. And it just turns out that on the SML in this diagram, that matches up with a beta of 0.7. So evidently, beta equals 1 is the market risk premium. If I had some asset that had a beta of 0.7, what should I expect its rate of return to be in this diagram? I walk into the room and say, guess what? I've got a share of stock here for the XYZ Corporation, has a beta of 7. What do you expect its rate of return will be in the future? Rate of return is about 10%. It's expected rate of return. This is the model that William Sharpe devised. Now he wasn't just laying around one night and says, I think I'll write this down. No. There's some underlying theoretical considerations, a lot of math, and some close reasoning. And the bottom line is the capital asset pricing model. And it's also called the security market line. The SML relates expected return investors' demand for a security to its beta. I would put this a little bit differently. I don't like these words at all. I'll use them because that's what's in the book. But I would put it this way. If you are an investor, what would be reasonable for you to expect for the rate of return for a particular asset? The answer is, if its beta is 0.7, and if the T-bill rate is 4%, and if the market rate of return is 13%, then I should be comfortable expecting 10% out of this asset that has a beta of 7. And then guess what? If this is a good hypothesis, then every security in the market will fall somewhere on the SML if it is priced correctly. What would happen if we found a particular security that plotted up here? Well, let me use instead the same. Has a beta of 0.7, but it plotted up here somehow and it had 12% rate of return with a beta of 7. It's undervalued in the market. Its price is too low in the marketplace. And if its price got bid up, its rate of return would go down. And so if I thought I found a security up here, I'd be very interested in buying it. And of course, if there really were such an undervalued security, it'd be like that $100 bill that falls to the street in New York. It never hits the street before it gets picked up. And the notion is that buyers and sellers of securities force the prices through their offers and bids, force the prices to conform in such a way that every security in the market falls somewhere on the SML. Is this the real world? No, this is a theoretical construct. In a world governed by the assumptions of the theoretical construct, it would be exactly true. So it must be the case that the assumptions of the theoretical construct do not perfectly reflect the real world. And indeed they don't. Because one of the underlying assumptions that's necessary for this to be true is that all the financial markets are in equilibrium. Not moving toward equilibrium, but in equilibrium. Are they? Of course not. No market's ever in equilibrium, for goodness sakes. It's always moving toward equilibrium. Does it ever get there? Of course not. The world changes before it can. But markets are those things that do move toward equilibrium in terms of the prices that they generate. So you begin to see why this is a theoretical construct. It's not a reflection of the real world, but it's useful. It is a very useful way to think about what rate of return should I expect if I invest in the XYZ company. What do you need to know to use the model? You need to know the beta of the asset. You need to know what is the market risk premium. Can you know that? No, you can only know an average of past market risk premiums for particular periods of time. Can you know what the T-bill rate will be going forward? No, you can only know what it has been looking backward. So how useful could this capital asset pricing model be? Well, it's a great way to explain what happened. Is it particularly helpful to say what will happen? Guess what? It's better than nothing. Is the future under any obligation to repeat the past? No. No, in fact, David Hume, that famous British philosopher, said the very thing. The future is under no obligation to repeat the past. The sun doesn't have to come up tomorrow. There's nothing that makes the sun have to come up tomorrow just because it has for the past few million years. Right? But what do you believe? Is the sun coming up tomorrow? Yes, you rather imagine that based on the model of the universe that you have, it will. And that's all you really do have is a model of the universe. You have the model of the solar system in mind. Okay, so this is to be taken in the same light. So I don't want you to fall in love with this. Say, well, if I just knew the beta of some asset, well, by golly, I'll know what my rate of return is going to be if I just buy that asset. No. And furthermore, we also learned that this is all true only in the context of holding that asset in a diversified portfolio, for goodness sakes. Didn't we? So there is a risk-return trade-off. We see it here. The more beta you're willing to accept, the higher is the expected return that you can expect. You won't necessarily get it, but you have every right to expect it. But only if you're holding that asset where? In a diversified portfolio. What if you're not holding it in a diversified portfolio? SML doesn't speak to that. The risk that you'd actually be exposed to is just going to be probably measurable by the standard deviation of the rate of return of that particular asset. And you can't know that going forward either. You could only calculate that looking back. If this all sounds like it's getting rather complicated, it is. The world is more complicated than assuming we know what the cash flows are going to be in the future, isn't it? All right, so on slide 11-7, the opportunity cost of capital, here's that term again, is the return that investors give up by investing in a particular security or capital project rather than in securities of equivalent risk. Equivalent risk. If the risk is not the same, again, you're comparing apples to oranges. If I told you the rate of return on XYZ shares is expected to be 12% per year, and then I told you that the rate of return on ABC shares is expected to be 4% per year, which would you prefer? You would prefer 12? What if I told you it's 10 times as risky as ABC? Ah, it was a trick question. I sucked you right in. It's got you. It's like I got Jariel a minute ago. Sucked him right in. No, it's a trick question. And this is what Bill Sharp was insisting on us coming to understand. Yes, there's a risk-return trade-off, but by goodness sakes, you can't compare two assets one with the other without knowing something about their risk, can you? And he summarized a way to think about the risk in terms of the capital asset pricing model. How could we compare the risk of two assets? What if I told you this now? What if I tell you this? I tell you that the shares of XYZ Corporation have an expected rate of return of 10%, and the expected return of ABC Corporation shares have an expected rate of return of 5%. Which will you prefer? What should come right out of your lips immediately is, what are their betas? Because if I told you the beta of XYZ shares is 2, and the beta of ABC shares is 1, now what would you say? I'm indifferent. They are the same once you risk adjust them. Do you get the idea? And that gave us the Sharp ratio. The Sharp ratio is a risk-adjusted rate of return that involves the use of beta. I don't think we study that in this chapter, but who cares? All right, so financial managers do use the capital asset pricing model to estimate opportunity cost of capital that they should expect to have and face. You need the opportunity cost of capital to do capital budgeting decisions, don't you? You need to use that as the discount rate when you calculate net present values. You need your opportunity cost of capital. Or you need to compare your internal rate of return on a project to your cost of capital and only undertake those projects that have an internal rate of return greater than your cost of capital, don't you? Well, where are you going to get your cost of capital? Well, that's another use of the capital asset pricing model. The company cost of capital is the expected, I left off an AD there, expected rate of return on slide 11-7, expected rate of return investors demand from the company. Well, now what does that mean if they demand it from the company? I keep beating on you about this. It means it's what's reasonable for them to expect from this company. That's all. They don't demand it in some sense. They don't even know what it is, for goodness sakes. But it's reasonable for them to have an expectation of a rate of return. And that's the company cost of capital. Why can we interpret it that way? Because presumably investors will not give this company their money unless they can have this expectation of this rate of return. But if the company must deliver that rate of return to get them to buy the shares, well, then that's their opportunity cost of capital, isn't it? From one point of view. The CCC depends on the average risk of the company's assets and operations. The company cost of capital just depends on the average risk of the company. So Kroger's average risk is much less than, let's say, Biogen Plus, doing experimental research on how to get your genes to behave a certain way. Right? Which one has higher risk? Well, it's pretty clear that if you're going to buy shares in Biogen Plus, you're going to have a pretty strong constitution for risk, aren't you? You're going to buy shares in Kroger, you just have to be pretty comfortable with the idea that people are going to keep eating. Right? And that Kroger's going to supply groceries well enough to get some of the business. All right, so you begin to see then that we can talk about the average risk of a company in terms of a company beta, couldn't we? And we could start talking about projects that the company is going to undertake or is considering undertaking in terms of the beta of the project. The opportunity cost of capital is determined by the use to which the capital is put, of course. Project risk for a particular project isn't the same thing as the company's risk, is it? You could have a project that's much riskier than the average risk of a company, couldn't you? So you could have Kroger saying, what if we go into the used car business? We'll sell groceries. We'll have used car lots out in the parking lot. Well, that would probably have a project beta different than the average risk of Kroger's, wouldn't it? Sure. But we can think of a project and its risk. We can think of a company and its risk. The project cost of capital, what is that? By definition, it's the minimum acceptable expected return for a capital project given its risk. So you can say, well, given the nature of this project, how risky the returns on it are likely to be, what we're really saying is how risky are the cash flows out there. You know, it's very interesting now to begin to think of those cash flows in the net present value calculation, not as single numbers, but as the means of a distribution of possible cash flows. You see how that works? So we learned to do NPV analysis, didn't we? You got all these cash flows that extend into the future. In the past chapter, we just treated those as numbers. Now we want to think of them as the means of a distribution sitting out there. And we don't know which particular number is going to come out. We just know it's mean. Or we persuade ourselves that we know it's mean. I'm fond of arguing, you know what? We don't even know it's mean. Not really. God, we're dense, aren't we? We're dumb. No, we're humans. We can't see the future. But this is the only tool we have. When we're faced with uncertainty, the only tool we have is the language of probability theory. That stuff you had a close brush with in business statistics. But not a very strong brush, just a close brush, right? It's like two ships passing in the night, really, wasn't it? You know, one does not come to an understanding of probability theory easily, I don't think. I certainly didn't. I came kicking and screaming and begging, but I did come. And now it's like an old friend. It's an easy way to think, but it takes practice. Cash flows associated with a capital project should be viewed as the statistical expected values of those cash flows. That's what I just said. And that's the end.